In this video, I'll take you through what is commitment charges and how to calculate that as well. Commitment charges means basically a charge levied for not utilizing the limit. So why banks are levying this charge? When a bank sanctions a line of credit or say a cash credit kind of facility, they basically set aside the fund for the customer so that he can utilize the sanction limit whenever he requires that. So bank has set aside the funds and that customer should utilize that fund, only then bank will get revenue in the form of interest. And if that customer is not going to utilize the set aside fund, then there is going to be opportunity loss for the bank. To cope up or to cover up at least a certain portion of revenue foregone, banks will be levying this commitment charge. So this is basically a charge levied for not utilizing the limit. It means if that fund had been given for some other customer, bank would have earned interest. In this case, it is not earning that interest. So it is earning or it is trying to earn in some other form in the form of charges. So these commitment charges can be a flat charge. It can be fixed on the entire amount, or it can be flexible, meaning it is levied only on the unused amount. So this might sound contrary for you. Why I said it can be a flat on entire amount. See, this happens in many cases where bank, when sanctions this line of credit or cash credit, they'll say commitment charges so and so percentage, which we are charging flat right now. And this charge will be refunded at the end of the tenure of this facility if you have made optimum utilization of the limit. So when commitment charges are levied, only when you are not utilizing the required level. If you are utilizing it fully, the need for commitment charges does not arise. So what the banks will do, as a safety measure, they will charge that, or they'll collect that money upfront and they will refund it to the borrower at the end of the tenure of that facility if the borrower has made optimum utilization of the facility. Then when it is flexible, here bank do not want to burden the customer initially itself with this charge. So what the bank will say, customer, try to utilize the limit at least at the minimum level, whatever prescribed in the sanction letter. And in case if you are not utilizing at that expected level, we will levy a charge. And it's going to be flexible. It will be calculated on unused amount at periodical intervals, which can be annual. And on that, this charge, which can range between 0.25% to 1.5% bank to bank, this could vary. This charge will be levied. And already I said charging intervals can be annual, and in case of fixed, it can be upfront as well. So how to understand this commitment charges calculation? Let's have a look at this example. Look at here. This particular customer was sanctioned a CC limit of 100 lakhs. And the sanction letter stipulates that customer should have minimum utilization of 60% at any point of time. It means at any point of time, the minimum of 60% of 100 lakhs, that is 60 lakhs, should be used in order to avoid commitment charges. Okay. So this is the sanction condition as well. Let's see what happened here. I'm going to call this as scenario 1. In scenario 1, the actual utilization is only 45 lakhs. Okay, on an average in that period, the average utilization is 45 lakhs. But to avoid the commitment charges, what should have been the minimum utilization? It is 60 lakhs. So there is a shortage, or we can say there is an underutilization. Required is 60, actual is 45. So there is an underutilization of 15 lakhs. So here there are two schools of thought, or banks differ in this practice. Here we can say the underutilization is only 15 lakhs because what is stipulated is 60. What was actually utilized is 45. So there is an underutilization of 15 lakhs. Or another call can also be taken. Sanctioned limit is 100. Actual utilization is 45 only. It means there is an underutilization of 55 lakhs. So how banks are going to look at it? It varies bank to bank based on their policy. So in this case, what I have written is Actual utilization is 45, minimum required is 60. So there is an underutilization, basically the difference of these two, 15 lakhs. So if this underutilization is considered as a base, and if on this, if charges are going to be levied, that is on this 15 lakhs, let's say at the rate of 0.25%, we are talking in lakhs, so this would work out to like 3,750. Or let's say the bank is going to look at it from the other side. That is, bank is going to compare the 100 with 45, and if it is going to come to a conclusion that unutilized amount is this 55, then on this 55 at 0.25%, this will be the commitment charge. Okay, so here I'm not giving a standard format for computing commitment charge, because bank to bank this practice could vary. So it could be either of this. So whoever watching this video, please refer the circular or instruction of your bank on how it is calculated, but this could be a base structure. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking Credit Courses Bundle. This includes course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.